You're listening to Market Champions, a podcast on navigating the financial markets. Here's your host, Srivatsan Prakash.
This episode of Market Champions is brought to you by Simplify ETFs. For more information, visit simplify.us. No simplified funds will be discussed during this podcast. Hey guys, welcome back to another episode of Market Champions. I just wanted to remind you to like, subscribe, and leave a comment. Really helps the page grow, really helps the podcast grow. Thank you so much for your support. And now on to the interview. Hey everyone, welcome back to another episode of Market Champions. Today we've got Kupperman, also known as Cuppy, and he needs no introduction. He's the manager of Praetorian Capital. He's also he's sort of like one of the best known investors on FinTwit as well, and sort of really well known for his plays in energy, etc. Almost needs no introduction. So thank you so much for being on the podcast, Cuppy. It's awesome to have you.
Hey, really do appreciate it. Excited.
Yep, awesome. So before we get started, I wanted to ask you, could you give the audience a quick synopsis, of your background? You've been on the podcast before, but just in case, someone might not know where you're from or who you are. So
yeah. So I started trading stocks in high school instead of going to class. I almost failed out of high school. And my senior year of college, I started a hedge fund, very successful. Along the way, started a property company in Mongolia, which we'll talk about in a little bit. And I really, in 2019, decided to refocus my energies on the hedge fund side of the world. It was a very successful hedge fund. I think it's probably one of the better performing hedge funds out there. I mean, it's 3 years old, so the track record is not that long. But I mean, I think we have one of the better keggers out there while taking very minimal risk. And so, that's basically my background. From a strategy standpoint, most of the money in the world comes from inflections where, look, they have these computers these days that can model almost anything. So anything that has a linear progression will get modeled. The opportunities are companies that have volatile quarterly, yearly earnings, companies that are cyclical, companies where something's changing and it's not showing up in the numbers yet. That's where the opportunities are, and that's really usually where I go hunting around. And I usually supplement that with some event-driven gains because it's nice to have cash flow. And when you think of it conceptually, Berkshire built the best model, I think. He gets to use other people's float. He gets to have continual cash flow from his insurance underwriting, and he gets to use that cash flow to reallocate into whatever securities he wants that are cheap. And if you have money coming at you almost every month, there's going to be one security you own that's had a down month, or if nothing else, you start a new position. The event-driven book consistently produces cash flow that we can reallocate. Plus, it helps me flag stuff that I probably would have missed. Some of the biggest winners this year, the event-driven book, is bankruptcy restructurings, where companies come out of bankruptcy and they trade too cheap. And some of these actually are the sort of inflection sectors like energy that have big tailwinds I'm investing in right now. But we can get into all that stuff later. That's my background. That's what I've been doing. I've been doing this for more than 20 years. And very successfully.
It's awesome. And, I wanted to start off by getting into energy first. And, you've sort of become very well known for your views, both on stuff like oil, but also on stuff like uranium. So, what's the latest in uranium? How are you viewing sort of the pullback that we've had over the last sort of week or two? And just in general, what's new?
So there's nothing that new in uranium. Sprott put out another bigger shelf. If they actually execute the full 3.5 billion that they're talking about, I mean, you're talking about more than half of total uranium supply globally disappearing into this entity in a year. It's a crazy number to think about. The price of uranium is going to be volatile. It's a global commodity. It's a very niche global commodity with a handful of producers and a handful of consumers. And so it's going to be volatile. It's it's not an active futures market. I mean, there's a spot market, but it's not even that active. There's only a dozen participants in that market in terms of brokers. So it moves around. People got really super excited when Sprott showed up and started gobbling up pounds. The price went from 30 to 50. Fortunately, I bought mine at 30. And it pulled back, and it's been a consolidation. If you look at a chart of it and you didn't know what the product was, you'd say this is a very bullish chart. And every week we're putting a few million more pounds away. And eventually they're going to consume the mobile physical supply of uranium, and the price is going to start going up. There's been sort of a lack of contracting. I think a lot of utilities are taking a wait and see approach, and they're hoping that Sprott slows down, the price pulls back, and I think if the price starts going, the utilities will panic and pay up. It's very much like any other stock chart. There's the floor at 30, there's a ceiling at 50. And if it breaks above 50, suddenly all the sellers become buyers. So I think this is working really well. When I look at investments, and I've done this a long time, most of them tend to track roughly where you think it's going to go. Sometimes, you'll exceed by a little. Oftentimes, it turns out you were too optimistic, and the guy selling you the paper were correct, and it just kind of goes nowhere. It flames out, and you stop out and move on. I'd say about 80% of my theses, you expect real fire, and there's a bit of heat, but it's just nothing. It's not what you expected in terms of the inflection. Uranium is the rare one where every week I wake up to a new headline that's more bullish. We've seen China order 150 more nuclear power plants. I mean, that's insane. We've seen France go pro-nuclear. They're going to start building some. They were talking about retiring them. Illinois, kept 2 power plants on. It doesn't sound like a lot, but it's on the margin where commodities get priced, and it increasingly looks like uranium is going to be seen as a green energy. And green energies, you get a better multiple on it. In the end, most of the money in the world isn't made so much on guessing the PE multiple, guessing next year's earnings. It's guessing where sentiment will shift. And if uranium is seen as being green, it's not going to be, classified with all these energy stocks at 2 times earnings. It's going to get a green multiple.
Yeah.
And the energy, the Kazatomprom of the world, which I'm wrong, is the largest uranium producer globally. You look at a green multiple. What's a green multiple? Maybe it's 30 times, maybe it's 50 times. It's very easy to plug in how many pounds they produce, what their cost basis is. And, the only thing in your model you have to really model is what you think the price will be. But everyone's still thinking this thing's going to single digit multiple. What if it's 30, 50, 100 multiple? I don't really know. But it's green now. It can go into all the ETFs. It can go green. I'm just saying there's a lot of good things that can happen to you. And the trend just keeps getting better, in my view, in terms of total demand side. And the supply side is sort of fixed. There's only so much uranium, and it's there's a 2-3 year lag to turn McArthur River on, and everyone else has a 5-year lag. Like you can kind of get a sense of where the supply side is.
Yep, absolutely. And one thing that you've sort of mentioned about uranium is that you've reached, or you've used your max allocation for the uranium trade. So I wanted to ask you, what does a max allocation look like for a portfolio like yours, and how do you think about concentrating in a position versus diversifying among positions?
So it's very clear cut what a max is. At my hedge fund, we've told investors we won't go above 35% at cost. We believe very strongly that you let your winners run. When you run a concentrate book like I do, it's not so much the mistakes that sink you as it is the winners that really cover up the mistakes, I guess. Of course, if you don't have a concentrated book with 6 to 12 ideas, you're not allowed too many mistakes, but most of the mistakes are, you may lose 10%, 20%. It's kind of like a rounding error in a whole basket of these things. It's the 5 and 10 baggers that make the performance numbers. So I think it's safe to assume we did a position max at 35, and it's actually done better than the rest of our books. So we're into the 40s. But when you look at how I think about it, junior uranium producer is very volatile, it's very risky. I've seen many times one of these things go from $1 to $3, and suddenly they need money for their drilling program, and they raise $20 million at a nickel, and there goes the whole value of the company. And so that's not where we're focusing our capital. We mostly own Sprott, the physical uranium trust. We own a bit of Yellow Cake just because I have a cap at 20% in terms of any one ticker symbol, and I just wanted more exposure. And then we own Kazatomprom, because it's the world's largest producer of uranium. They're kind of like OPEC. They'll set the price. And I think they have the most leverage to pull to create value. If it wasn't in Kazakhstan, we probably would have made it a bigger position, but it's a pretty damn big position anyway. It's government controlled. I assume that, some of the tail risks are removed there in terms of corporate governance. I mean, you kind of know what you're getting. And you're just taking country risk. And the government of Kazakhstan owns 75% of it, and has been pretty clear they intend to pay out a dividend because it helps the state budget. So I don't know, it's Kazakhstan still. But that's how we've structured the portfolio. I got some odds and ends of some little, hiker junior stock promoting things, but none of them are above, 50 bips.
Yep. And the other side of your energy trade has been being long sort of the oil futures curve. And wanted to ask you, what are your thoughts on something like carbon futures as a way to play this quote unquote energy crisis? Number one, it's sort of green, and number two, it's still a play on energy.
So in terms of carbon, we haven't touched it in any way. We have no exposure. I doubt we ever will. I don't like investing in stuff that only exists because some politicians created some scheme to enrich some of their buddies and screw over some of the political opponents. What I've learned is that you have economic cycles, you have political cycles, things that are really popular like carbon become unpopular. Eventually it's a tax that must be paid by the consumers. It all get passed along. And it'll make the end products more expensive. And you'll eventually end up with a politician that promises voters that they'll get rid of that cost. And that politician will probably win by a landslide because nobody really wants to pay an extra couple dollars for their gasoline or their, any other products. And this product will disappear. And one day it'll just go no bid because there's no fundamental reason why it needs to exist. And, the guys who get hurt are a bunch of, hedge fund intermediate and trading houses and the big, banks of the world. Like those are the sort of guys that if a politician told me that I could screw over some hedge fund, some other guy often came in and, a big bank that has like a couple $1 billion derivatives book of this thing. And then there's like some French guy and some German guy that owns these things. I'd vote for the guy. Like, my gas will be cheaper. It's great. So these things don't exist with any logic. And so they'll cease to exist at some point. And I won't be able to time when that exit is. And I don't like to short. It's probably too early in this mania to short. So we're just not going to do anything.
Yeah, and in terms of oil, the one thing that we did see over the last week, which sort of made the headlines, was Joe Biden wanted to release a very small amount of the SPR. So obviously that doesn't change much. But do you think that that's sort of evident that policymakers are eventually going to step in and try and actually reduce the price of oil? Or do you see any? So what are sort of the major risks that you see to the long energy, long oil kind of thesis?
Well, Joe Biden is going to release 30 million barrels, 50 million barrels.
Yeah.
I mean, it's such a rounding error. I forgot. It's something like 12 hours of global consumption. It doesn't matter.
It's like 3 days of U.S. supply. Yeah.
Yeah, it doesn't matter.
Yeah.
In the end, we're running 1 million or 2 million barrel global deficit every day. That deficit will expand because you have a lot of countries that are reopening and their economies are growing fast. You have minimal new supply coming. OPEC is bluffing. They don't have what they claim they have. You have guys like President Biden who are actively trying to make the price of oil go up so that they can, accelerate the transition to green, which, I'm totally different. You want to have green, you want to have carbon. I don't really care, but you can't transition to green if you haven't built green. Yep. And so, I think you have guys like, Larry Fink that really want to have an energy crisis. They believe in this thing. It's almost religion to them. And so we're probably going to have an energy crisis. And, the Strategic Petroleum Reserve is designed for a true emergency. It's designed, if there's a hurricane or a pipeline burst or, there's a fire at a plant or something. It's designed for true emergencies because it's really not that much oil. And so, you can't just, use it because your approval ratings are declining. Like that's not what it was meant for. And I think it's just a terrible precedent for a government figure to be doing this. And I don't want to just blame it on Biden. Multiple presidents have done this over time, but it's just a dumb thing to be using. And I think oil's going a lot higher. I'm playing it. I own the 2023 and 2025 calls. I own call spreads. I own just straight calls. I think it's going to massively overshoot. And I think it's one of the better trades on my screen. The fact that, a couple months ago, I could buy the December 25 100 strikes for $2 is kind of crazy because, I don't think people appreciate right tail risk, AMC, GameStop. They showed you that right tail risk is almost infinite, but the guy who owns GameStop, he's eventually going to take profits. What's the point of owning it if you're not going to sell it? What we've seen with like the UK gas market is that there's almost no price that's too high because it gets cold. People need this stuff. And, I tend to think governments will actually subsidize increased usage as it starts going up and upsets voters. And so, why can't oil go to 500? Why can't those things be, 200 baggers? I'm not saying that's, what I think is going to happen, but it's definitely not priced like there's a 10 or 20% chance of that. And, you could write the 50 put and fund the whole thing. You could actually probably overfund it. I just think there's a lot of opportunity there. I don't want to take, individual company risk. Biden's already talking about excess profits tax. Who's going to drill a well if he tells you that, it's 100% tax and everything over 60? Like, you're never going to drill a well because those wells are probably 60 break even.
Yep.
I don't want to be the guy who has all this PDP or all these drill locations, and those wells are getting more expensive too. Talk to the service providers. Think of what goes into a well. You have labor. You can't even find the people. You have steel. You have lubricants. You got sand. Everything going into a well is just doubled in price. Those wells that they used to lie and say that they were break even at 40, those are like break even at 60 or 80 now. Mm-hmm. And I think those are fake numbers anyway. I just think the price of oil is going to go up and the politicians are going to penalize the producers. And I think you just want to be long the physical. And it's very different from a lot of the investing I do. But as long as the futures exchange is still there, I'm probably going to make a lot of money. And I get a lot of upside leverage. In Project Zimbabwe, right tail risk is always mispriced. So sorry, I don't know if I've answered your question. One of the things I'm worried about, I'm truly worried that governments panic and do another lockdown. And, it's a short-term thing, but you might hit the demand side for a couple months, but no one's going to drill if that happens. And it just basically makes the amplitude of the move in 25 bigger. I'll probably have to sweat through some pain in 22 if they lock it all down. Yep. But that's why I went out in duration, and they're like almost zero delta calls anyway, so I don't think they're going to move much. But no, that's really the risk I see, and no one really knows what these guys are going to do because they're insane and they're making decisions based on last week's polling numbers. It has nothing to do with science anymore.
Yeah, and the other thing that you mentioned at the start of our interview was Mongolia Growth Group, and I just wanted to ask you because so could you sort of talk about number one, the thesis in Mongolia and what you've got going there.
So yeah, no, I'm happy to chat about it, but I haven't really talked about it much in a very long time because there's nothing really good to say. Look, we started a company in 2011 to invest in Mongolian real estate. It was the fastest growing economy at the time. It was booming. I was super optimistic. I put over $3 million of my own dollars into it, and it didn't work. A year after we started it, they had an election, and the guys who won banned foreign investment and arrested all the foreigners and seized a lot of assets, and they just crashed the economy. And these guys haven't figured out how to get the momentum back, even though we're in a commodity bull market these days. They haven't figured out how to get the country to grow. And we were a subscale property company that didn't hit scale. We didn't raise enough capital to be really a public vehicle. We have corporate overhead costs. And given the economic crisis, we were getting a fraction of the rents we expected. And then the currency collapsed, so we got a smaller fraction of that fraction. And we stuck with it for a decade, but eventually realized that this wasn't a viable business, and we sold some non-core assets. It took a long time to monetize anything. We sold some non-core assets. We're going to keep our core team there and keep the core portfolio because one day Mongolia will recover. I hope it's in my lifetime. But we extracted some capital and we started investing. And, we've had a really good run of investing over the last few years, even though, we've had a $500,000 to $1 million corporate burn every year. We've overcome that and grown the book. And, for the first time in a very long time, I'm truly optimistic about what we have, because we have enough capital now to actually pivot the business and choose a new direction for our company. And we publicly announced with the Q3 earnings that we're going to become a merchant bank. And we're looking at opportunities to have control positions or semi-control positions in public and private businesses, and hopefully be able to exert influence and create value and lower their cost of capital. Small companies seem to always get penalized by Wall Street in terms of their cost of capital. They got to pay 6-8% finder's fee, and there's usually warrants and usually massive discounts. And if you can solve for some of this cost of capital and solve for some of the other stuff that we have decent amount of experience in, as having ran a small company for a decade, I think we can create a lot of value for some of these companies that we look to invest in. I mean, right now, the portfolio is mostly public securities. They've done very well. There's no guarantee they'll do well in the future. But we're also looking to incubate some businesses. We started a business, we spoke about it last time I was on the show, but we started a business called Companies Event-Driven Monitor. It's a newsletter that helps track over 20 event-driven strategies. I started with a very good friend of mine. There's actually a couple of people working on it now, so they all ought to get some credit. But I wanted it because I wanted the data from my own hedge fund. I've made millions of dollars off of just flagging some of these events I would have missed before. And so it's been great to me, but we decided to commercialize it because a lot of my friends wanted it. And we kind of realized that we could turn it from an Excel spreadsheet to a PDF and charge. And, we've been using that, the proceeds to hire more people and grow the business and improve the data quality. And, we still have some work we want to do on some of the data issues. But we really want to make this a product that anyone who is an active investor or trader will get value out of. I was out last night with two friends of mine, and it just makes me feel good that they say, "Hey, Cathie, you helped me flag this thing. We made $1 million. Help me find this other thing. I totally missed it." And we have this position on. We're up a lot. It pays for a lifetime of subscription if you flag one of these things. And so I'm really excited about it. We put this into MGG, and I don't think Ketam's ever going to be, the core of the business. I mean, it's just not going to be big enough. But it does cover all our corporate overheads, so we're a cash flow positive business now, and it gives us the flexibility to kind of take a deep breath and think it all through, because we've been this stick of dynamite that's been kind of burning the wick for a decade, and we finally stop and think through how to create a lot of value for people. And I own a quarter of it, so I tend to create a lot of value. And, you can look at the insider trading. I bought way too many shares when it looked pretty bleak, and now that it's turned around, I've still been buying shares. And, I don't know. I think it's a unique situation to invest with a team of people that owns a lot of stock, is very incentivized to create some value, and has a long track record of creating value. So that's my pitch to you. I recommend going to the Q3 MG&A and reading the shareholder letter. I think between that and the financials, it'll give you a good idea of where we've come from and hopefully where we're going.
Yep. And the other thesis that I wanted to get get sort of an update on, as well as sort of a quick background on, is Joe. And sort of everyone knows you as a big bull on St. Joe's. So could you sort of just share what the thesis is real quick, and if there's anything that's changing?
So Joe is one of the largest landowners in the state of Florida, primarily the Florida Panhandle, which I think is one of the most pretty parts of Florida. It's the only part of Florida that has rolling hills and white sand beaches. It's really quite beautiful. And demand for real estate in Florida is going parabolic. There's a couple of things driving this. You have big demographic trends, because Florida is a zero state tax state. So we're getting all the people that are leaving the Northeast. We've effectively decided COVID's over. And so you have all the COVID refugees that don't want to wear a diaper on their face when they go out to dinner. But it took a long time to hit critical mass there. You have this chicken and egg problem where people don't want to go live somewhere if it's not near, a hospital and near grocery stores and nice restaurants. And no one's going to build nice restaurants if there's no homes to support them. And so it's taken a long time to hit scale, and it's hit scale now. And if you look at all the metrics, they're all up 100% year over year and 300% over 2 or 3 years. Everything, and people really look at Joe as being lots that they're selling. They are selling lots, and these lots have very low cost basis because the land was bought in the 1930s. But there's a rapidly growing hospitality business, the clubs business, there's recurring revenue from the commercial business. You just have lots of different factors, and like many things in finance, when you're growing very fast, you don't show much cash flow. And if you contort the numbers a little, you see a whole lot of cash flow. And I tend to think this thing trades at, let's call it it's a $50 stock today. Let's say fair value, just very rough numbers. Let's say 200. Okay, so it trades at a quarter of fair value of the land. If you just sell off the pieces, if you call Cushman and say just fire sell this, I think you get 200. And then I think the value of that land is probably going up 20% a year. So you're making 40 on your $50 purchase price. So that's 80% a year for a company with net cash balance sheet, and you get all the cash flow too. I think it trades at a mid-single digit cash flow multiple on 2025 numbers if they were to in 2025 to stop growing. But instead what they're doing is they're taking the cash flow from this year and they're reinvesting that to prep lots for next year. And if the number of lots you're selling is doing this sort of thing straight up, well then it's just going to consume cash. And they're using the cash flow for their commercial development projects. They're building multifam and hospitality, and so it doesn't look.
It's a wonderful thesis, yeah.
But I think the best part, and the thing that people miss really is, I'm a bull on inflation. I think we're going to see a lot of inflation. Land tends to do really well on inflation. If you look like a home builder, less well, because Sri, I'm going to sell you a house that I intend to deliver next year to you. So we fix the price. Well, I don't know, where am I going to get labor from? What's the price of roof shingles and copper pipe, and I don't know. So I'm taking all this inflation risk, delivery risk, deadline risk, and I'm going to get squeezed. I know I'm going to get squeezed. And so it's not the best place to be. Plus, it's capital intensive. Your funding costs are going to go up. It's not really where you want to be. You want to be the guy who just owns the land and farms the land out and the lots out to someone else. And I think in an inflationary environment, you're going to do very well with a big macro tailwind. I'm investing this thing at like a quarter of liquidation value. There's no, financing risk. It's one of those dream scenarios you don't see very often, and it's horribly underowned by most investors and index funds. And as that corrects itself, I think this thing goes to fair value, and it probably overshoots because these things always overshoot when you have a good macro. But I think what people are missing about it is that Joe has a lot of undeveloped land. So if you were to build, a strip mall and you put some nice restaurants in it, you put a grocery store, then you draw a circle around that, and within 2 miles of that, the value of your lots goes up. You were looking to sell lots for 150 grand a lot, or now they're $200,000 lots, because in the overall purchase price of a $1.5 million home was 50 grand. But that's all gross margin to Joe, and you can accrete that gross margin because when a guy who goes to look at a spec home, he says, "Oh, I can see myself eating dinner here. I can see, look, there's a new clinic here, and there's a grocery store." Like, you can see it. Whereas otherwise, it's just kind of timberland right now. And so as they add value in places, the rest of their acres increase in value, and you have this flywheel that I don't think people give enough credit to. Anyway, this is outside of Sprott Uranium. This is my biggest possession. It'd actually be my biggest possession, but Sprott Uranium just keeps going faster.
Yeah, and with these theses, what does your process actually look like for finding ideas and researching them? So how do you actually go about finding ideas, and what happens after that before you take a call on whether to pull the trigger or not?
My process, I don't want to say there is a really clear process to this, because a lot of times the process starts by looking at what's happening in the news and saying, governments usually make 2-year decisions because you have 2-year election cycles. And so you're looking at what the government does in the news, and you say, what's cause and effect going to look like out 3 or 4 years, or even out 3 months. If they're going to favor this thing, how is this other thing going to either benefit or get harmed? And that's usually where I start the process. It's sitting around beers with some friends saying the government just screwed something up, and how are we going to make money out of it? It's kind of a sad place to be, because that there's 330 million Americans, and maybe 50 million benefit from whatever dumb decision, and 200 million are going to suffer, and I'm probably going to make money. But that's usually where we start the process. And then from there, we see these trends in motion. How do you get exposure to that? How do you get leverage to that? How do you get upside without taking balance sheet risk or corporate governance risk, or all these discrete risks that companies face? Because, like I said, I run a 6 to 12 name sort of portfolio. I don't have the flexibility to have big mistakes. I mean, I could get it wrong and I get my money back, but I can't be down 50 on a mistake. I mean, it's going to really hurt. So, that's usually the next step is, so we see a trend in motion, okay? People have been leaving the Northeast for 100 years to come to Florida. This trend, it kind of goes in a sine curve, it accelerates and it slows down from time to time. We're in an acceleration phase right now. We know this. I don't think anyone will dispute the trend. The question is, how do you make money? And, we looked at home builders, and we looked at the history of home builders. We looked at everything in the supply chain. I ended up buying a company called Cornerstone. They make a lot of components for housing. They're the largest producer of windows in the United States. They make siding, they make stone facade, they make gutters. I mean, it's not sexy stuff by any means. But if you look at U.S. home demand, it peaked out well over 1 million single-family homes in 2007 and 8. And it's been 600,000 to 800,000 for over a decade. And these guys were earning 25% of their capital, year after year at a 600,000 to 800,000 unit level. Well, we're well above 1 million now. We're probably 1.25 million, 1.5 million. You'd expect that their returns on capital accelerate because demand's going up as a commodity, and you'd expect that volumes go up, and so their revenues go up. And so if you take a company that you think is going to earn a 30 or 35 return on capital, you put 3 turns of leverage on it. These guys are a little higher. I mean, you're making 100% of your money each year. That's a good place to be. And that doesn't include the fact that their revenue is going to explode. It's almost predictable what happened. I mean, you listen to the conference call, and they literally can't produce the stuff fast enough. And that's a good place to be. I mean, most companies, they're focused on how do we sell more. Let's focus on marketing. Let's focus on sales channel. Let's focus on getting a little bit better product than the other guy. And these guys are saying, if we can just get rid of the bottlenecks, we'll produce 20% more of this stuff. And we know we can sell it. And we raise pricing 15%. We still know we can sell it, So I like those sort of companies where you're in a bull market. And I mean, I've seen this before many times. And you have real constraints in supply chain. And people aren't pricing in what it looks like when they de-bottleneck and add a bit more capacity to produce. And I mean, I bought this thing like 2 times cash flow. It's hard to get hurt.
Yeah.
I mean, this is financial leverage, but I paid like 2 or 3 times cash flow for the thing. I mean, it's already a triple, and I think there's a lot of blue sky there. And then we bought Joe for this, similar kind of thought process of who's going to get the returns on capital. I mean, they're taking acres that are on the balance sheet for almost zero in the 1930s, and they're monetizing them. They're not taking all the risks, and I think they're going to get a very good price for a lot of their acreage. And I'm buying it for fractions of a dollar. But it's like energy. Larry Fink went out there and said he wants to create an energy crisis. I mean, he controls 10% of the votes in every large corporate. He's friends with Vanguard and some of these other guys. If they really want to create an energy crisis, I think they'll succeed, especially if the president is going to help them. So we'll have an energy crisis. Then you ask the question of how do you make money in an energy crisis? Well, I don't want to own U.S. energy producers, and I don't trust corporate governance overseas, because the places that are going to see incremental growth of energy, it's going to be places that I don't really trust corporate governance. I don't really know how to invest in those places. I can barely find them on the map. But I bought a company called Valaris. They're the largest owner of offshore drilling equipment, because I think the incremental growth going forward a few years is going to be places like Guyana and Brazil and Angola, and Gabon. This is where the incremental growth is going to come from, and it's all going to be offshore, and demand for drilling rigs is going to go up. And kind of same as with Joe. I bought a company that has a net cash balance sheet. I paid 10 cents the dollar for replacement cost of the equipment, and it's cash flow positive. And the wind's at my back. It either works or it doesn't, but I don't think I'm gonna lose much money. And so far it's been working. But that's kind of how conceptually I think of stuff. And there's a lot of trends like agriculture. I'm super bullish. I think the price of ag goes up because fertilizer is going up, but I haven't figured out how to play it yet. And a lot of times you spend a week or two or a month and you hit a dead end and you put it in the too hard pile. And that happens a lot too. You don't need that many winners to have a really great career.
Yep. Yeah, this is sort of, goes back to what Charlie Munger said, most of the things do fall into like the too hard pile. So, and
there's a lot of too hard pile.
Yep. And recently on Twitter, I think it was a few months back, you're talking about like a catastrophic, tail risk scenario. So what are sort of your favorite long vol trades to hedge against, hedge against just the general tail risk? And what are sort of the biggest tail risks that you see to the markets right now?
So I think the biggest thing that I'm really fixated on right now, obviously you have the progression of the virus, and if you vaccinate everyone, you're likely to create a vaccine resistant variant. I mean, this new they call it NU instead of NEW, but whatever. It seems vaccine resistant. It seems that they'll eventually create a vaccine resistant bug. And we've seen this in many medical settings. Hospitals been fighting back, different bugs that they can't seem to kill. I mean, and it's inevitable they'll create something, and it's a question of what it looks like. And I think it's a real risk. I don't know enough about the science. I'm not a scientist. I'm a generalist investor, but I also have read a lot, and it's troubling. And you can't hedge against a 1 or 2% outlier scenario because it's too expensive. I mean, it's more important to know what the potential risks are and be ready to reposition the portfolio rapidly if the news starts coming. Because as we learn with many of these sort of scenarios, you got a 1 or 2 week window where the price is down 1 to 5% and there's still bids, and then there are no bids, and you need to be able to recognize something for what it is and move fast if this sort of horrible scenario. So I keep them back in my mind. I probably spend way too much time thinking about it, but it's a risk. I mean, there's lots of risks when you have a phase 1 clinical trial that you try out on 2 billion people and have no primary endpoints. Or the primary endpoints move every week because the politicians need the endpoints to move. There's lots of unpredictable risks, and I don't know enough to quantify it. I just know it's something worth paying attention to. But the real thing I'm worried about is I don't know what the Fed's going to do. Jay Powell finally got the job. He's been ultra dovish for a year campaigning for the job. He has the job now. It's pretty obvious that inflation in the U.S. is mid-single digits right now. It's the highest it's been in my investing career. That's the official number. I think the real number is much higher. Politicians really loved, good inflation, which is when home prices go up and stocks go up. They like that good inflation. And we've had good asset inflation for my entire investing career. What they don't like is when the price of tomatoes and chicken and gasoline goes up and the voters start calling and complaining, because that's how you lose elections. And remember, we're in a 2-year economic cycle, and there's 1 year left to this cycle. And when people like my mom start calling me up and saying, "Hey, Harris, you wouldn't believe the price of broccoli," and I've never bought broccoli in my life. I don't get the prices, but my mom, it's registering in her head that the prices moved, and so it's obviously front of mind for voters, and which makes it front of mind for politicians. And politicians are going to go call up Jay Powell and say, "Do something." And he's flying a jet plane at 1 billion miles an hour, and he has 2 knobs. He's QE/QT, you can turn the knob, and he's got Fed funds, you can turn that knob. And he's just going to be reconfirmed, and I think he's going to turn both knobs and turn them very fast. And the question really is, does he do it tomorrow? Do you have a surprise 50? Does he do it methodically, in which case he's behind forever? And you can see the precedent of the 1970s where they're 1,000 bips behind, and then Volcker basically overshot it and killed inflation. But they spent years 1,000 bits behind. And, if you're going to be 1,000 bits behind, you're going to have a crazy bull market in equities still. But slowly it will crush the unprofitable companies, the Ponzi sector, I call it. It'll crush tech, which is just duration assets. But if he tries to be fierce and crush this thing, I think the whole world goes no bid. I don't know where you hide,
Yep.
And I also think he's in a tough spot because a lot of the inflation that we're seeing right now is being caused by energy. And on one hand, the government's creating an energy crisis. On the other hand, they're telling him to fix inflation. But I mean, the inflation is just starting because $80 oil takes a while to flow through everything. The government's creating, supply chain problems. The government's screwing everything up with labor and everything else. And they're asking JPOW to fix it. And remember, he's got two knobs. He's going to change the knobs. And, if he really is forced to fix it, he's going to crash everything. And this isn't a decision, go to cash and get out of the way, but it really bears paying attention to because Fed policy works with a lag, and you'll be able to get a sense of which way he's leaning and what he's thinking of doing. I mean, remember in 2018, he crashed everything into Christmas and then he panicked. But he only panicked because Trump threatened to fire him. This is very different. Trump was back then saying, I want the stock market up because it helps my polling numbers. I don't think anyone in the current administration cares about the stock market. I think they almost see it as the enemy. I think they're really worried about the price of broccoli and my mom not voting for them. And so they might actually be willing to crash the market. It's a very different construct because for 30 years, the Fed's been on our team. And I don't think anyone alive has lived through, I haven't, when the Fed's against my team, the Fed's the opposition, And so I think that's really the thing to watch and pay attention to. And I can see a world where the stock market drops half and oil triples, and that's the worst of both worlds for everyone. It'd be good for my bank, but I think you can start seeing a world where as oil starts going higher, and it's going to go higher, I think the rest of the equity market starts panicking that JPOW is going to be forced to overshoot. And I mean, people are focused on interest rates now, but when oil gets above 100, I think that's the only thing that's going to matter anymore. That's the risk I see.
Yep. And the other person that's in a tough spot right now is Cathie Wood. So what does the ARK endgame look like, in your mind right now?
So there's this fella named Munder. And I remember in 2000, he was on TV all the time. He ran the Munder Net Fund, and they did these pretty cheesy advertising campaigns. And, he bought billions of dollars worth of frauds and, all these little tech stocks that, they probably should have gotten to like 10, 20 million because they're just VC deals. They came public and they went into the billions or even tens of billions of value, and he owned all of them. And it was him, and he colluded with some other guys. Janus 20 owned the same stocks, and Bill Miller owned the same stocks. I'm not saying it's illegal to own the same stocks, but they kind of walked the things up. And then when it stopped going up, they started getting redemptions, and then the bottom fell out because you had about 10 guys that owned all the shares, and guys like me would look at these things and I'd be saying down 90%, I'm still not interested. It just went no bid.
Yep.
And especially when you have an unprofitable company that has to raise capital at all times. I mean, not only does it go no bid, but if there's no bid, you have no company. And so I think it's going to go really bad. It's already actually been going quite bad for her. She's down on the year. And if you assume that Tesla is over 1,000 bips per book and Tesla's been like a 5-bagger, you can see that the rest of her book's been melting all year. And I assume it's just going to accelerate. I mean, you get Bill Wang blow up, and that was one of the bidders, and I'm sure there's lots of little Bill Wangs, and all the Tiger Cubs seem to own the same fraudy, scummy stocks, and they're all blowing up now. I don't know. It just kind of looks bad. I don't want to be anywhere near anything that ecosystem. My worry is that when things go bad, it's not so much that your company is going bad, business-wise. The risk is it's cross-owned by the same people. And so, you have this momentum crowd that I'm worried they have some of my names somewhere tucked away. When they get a margin call, they sell my stuff. Like, that's what I'm worried about, the cross-ownership of this all. Otherwise, look, I have no position in Cathie. I try to short it once or twice. I keep saying don't short Project Zimbabwe. I've given a few dollars back. I'm embarrassed to say I shorted it, and so I'm not going to try it anymore. I just know what's going to happen eventually, because I remember Munder net went from being this big thing that was on CNBC getting interviewed every week, and then he lost 98% and got sued by everyone.
Yeah, no, you can sort of clear. Well, I've never heard of Manganet, but you can sort of clearly see the parallels. No.
Well, it was firsthand. What was it? Firsthand funds, and there were about 10 of these guys, and you looked at it, and you'd see that they owned 80-90% of the shares of these companies. It was amazing how colluded they were in a couple of names. And I don't know if they did it with malicious intent to manipulate the market, or they just all liked the same scummy companies, but they all were in the same things, and they just walked them up. And it was an artifact at the time, but you had these companies, and they'd IPO 2 or 3% of the shares outstanding, and it was easy to manipulate the share price because there was really no float. Yep. And now the share price gets more manipulated because you have guys buying weekly call options and they walk the stocks up that way. But when it goes bad, look, if you're walking up Tesla and your strategy is to sell a few 100,000 weekly puts to finance 3 times as many weekly calls, I mean, you're going to walk the thing up, and you're going to do it probably, depending on how you structure your trade, you might even do it with a net credit. But as we all know, if Tesla has a down 20% a week, suddenly that net credit doesn't really matter anymore because your calls are worthless. And you're going to be eating shit on your puts. And eventually the whole thing will unwind. And it'll probably unwind with a down 500 day. Like, I've seen this happen too many times. And the crazy thing is it can happen with a company worth $1 trillion. Because normally you see this happen with some $200-300 million stock.
Yeah, and moving on to another theme. So I believe you've briefly talked about cannabis elsewhere. So I wanted to get your thoughts. Do you see cannabis as sort of a potential investment opportunity? If you see the chart, people have been talking about sort of what you could consider a potential breakout on the MSOS, the cannabis ETF chart. So just wanted to get your thoughts on cannabis as a possible investment theme or like an investment play.
I really don't know anything about cannabis. I'm sorry. I'm a drinker, not a smoker.
All right, no problem.
Sorry.
No, not at all. So the other thing that I wanted to ask you was, do you have any advice on sort of starting and running a hedge fund? And you are like, for someone who's aspiring to run one in the future. You started one, I believe you said, right, senior year of university, which is insane for someone who is in university. So good. What's sort of your best advice on starting a hedge fund? And you've got some views on sort of how people run hedge funds today. You've sort of reverted to the old school, Soros kind of, almost looking at everything instead of putting yourself into one small bucket. I'm only long value, small cap. You're sort of you just look at the entire universe of investment. So what's sort of your best advice on starting a hedge fund?
So a lot of people start hedge funds that kind of go nowhere. I mean, I'm amazed how many people I meet that have $2 million hedge funds. It's friends and family, and you don't really cover your operating expenses. And after a few years, you give up and go get a job somewhere else. And I've just seen a lot of people go down that route, which is unfortunate, I guess. The thing about hedge funds is that the vast majority of hedge funds these days, they basically try to outperform the benchmark by a tiny little bit and do it by reducing volatility. And it's an artificial construct. But if you can give S&P performance plus 500 bips and do it by reducing volatility, you're going to raise trillions of dollars. Every endowment will give you money, especially if you don't own any energy stocks. And so I think that's been done to death now. And I think it's really hard to do that because if you're going to constrict volatility, you're going to hurt your returns. You're going to make up by having leverage. So you'll make up for the fact that you're going to underperform on a gross basis, being levered up, so you'll outperform on a net basis. And then you just take on lots of idiosyncratic risks. And these guys always blow up. There's a reason that they always keep blowing up. I think you have to do something really differentiated. But the secret to raising capital is you have to have huge numbers. I see a lot of guys go out there and they go, okay, I'm going to buy 12 compounders. I'm going to be a concentrated fund. Okay, like great, concentration is good. That's how you outperform. I'm going to buy 12 compounders. I'm going to pay 15 times. I think they're worth 20 times. I mean, you're going to maybe outperform by a couple hundred bips, maybe you won't. I mean, there's not, I mean, maybe over a decade, if you're really good at this, you will outperform by 500 or 1,000 bips a year every year, and you'll raise a lot of money. But it's unlikely that your first year, statistically speaking, is going to be, you know, enough outperformance to show up on anyone's radar. And by year 3 or 5, when you are showing up on someone's radar, I mean, how do you buy groceries with $2 million of AUM? You know, it's kind of like counterproductive in a way. You really need to do something that is idiosyncratic, that stands out, that produces value, that's different from what an allocator can do themselves. And when I say allocator, that could be your mom also. I mean, my mom can buy 10 compounders. I mean, she owns a whole large tech stocks. She's doing quite well, actually. Yeah. I mean, and so, you know, you really need to stand out. You need to do something special and different that you can explain to someone why you're special and different and why you're worth 2 and 20 or whatever your fee structure is. Remember, the hedge fund business is obviously it's performance based, but you need assets to make any money at it, and you'd be amazed at what your fixed costs are. And so to get assets, you need performance, but you need to stand out. And I see way too many people go out there and they say, "Oh, I'm going to buy some, you know, super small cap stocks, and you know, I think this thing is trading at 3, and I think it's worth 5, but it trades $10,000 a day," and that doesn't scale. So if you actually get a $5 million check, I don't know what you do with it. And that guy's not going to use $5 million because he's smart enough. I mean, if he got to $5 million, he's smart enough to know that you're going to buy $1 million of this thing, and you're going to run from 3 to 5 just buying it. You need to see something that really scales and that has that's different. And you better just smash the number. If you're going to beat your benchmark by a couple hundred bips, or God willing, if you fail and you miss your benchmark, like, you're not raising money. I mean, unless you came from some multi-billion-dollar, you know, shop and you get a $100 million check to start. Like, if you could be like me and you're going to basically go bang on doors, I've done that, you know, my whole life. Your numbers better be good. You know, thankfully, my numbers are great. Yep. And I'm doing something different, I think.
Yeah, and you know, could you sort of talk a bit about your approach to what you call periodic decrossing? You know, how do you come up with that? You know, how do you time it? And you know, how do you deal with it psychologically? You know, you're selling winners, you're selling losers, which is more painful. You know, there might be some FOMO as well. So how do you what's sort of your approach to periodic decrossing?
So I degross when I'm worried about something coming up. You know, we target about 115 to 125 gross long. You know, we have almost no short, so it's really just like gross and net are the same. But we usually target around 115 to 125. I'm running, you know, lighter than that right now, just because, like I said, I'm worried what JPAD does, and you know, I don't know what he's going to do. I don't think he even knows what he's going to do yet. But you know, it's obvious that there's going to be a problem sometime in the first half of 22. Either they let inflation run too hot and the market crashes, or he tries to do something about it and the market crashes. And so I tend to be, you know, we've pulled back a bit. You know, I see a lot of people that they want to, you know, they think something is worth 20 and they won't sell it at 18. They want to squeeze that little bit of toothpaste out of the tube, and that's fine. But you know, my view is probably I'd sell it at 17 even, because there's a lot of flexibility and optionality of having cash, or you know, even if it's not cash, even if you're running 105 and you know your target's 115 to 125. I mean, you've got yourself 2,000 bips of room to move around in if something interesting happens. And so I like that optionality and flexibility a lot more than, you know, that little bit of toothpaste. And so I tend to see stuff that gets near fair value and I exit, or I see stuff where the thematic is slowing down and I exit. As soon as, if you look at a thematic and inflection investment, you know, you have your first derivative and you have your second derivative. As soon as your second derivative starts slowing down, get out of the way, because these things usually get priced on the second derivative. And so if you're seeing it and you're witnessing it, probably a quarter or two from now, it's going to be in the numbers. And then, you know, it's all going to fall apart. Especially if you're doing inflection stuff like I am, where there's a lot of bad history in the names, where, you know, on the way up, it's a multi-bagger, on the way down, it loses 80. I mean, there's that PTSD ingrained in the ticker symbol. and people are going to overshoot both directions. And so, you just get out. And so that's kind of how I degross. I regross. At the bottom in March of 2020, we were 150 long. I mean, as soon as it was obvious that COVID was a bad cold and wasn't going to kill everyone, and that the governments were overreacting, over panicking, as soon as JPOW brought out all the liquidity, I just said, let's get as long as I can. And as the market went up, one of the funny things about being 150 is that if the market goes up 10%, your names go up once. You're no longer 150. You're in the 130s. You can add another 1,000 bits of exposure and take it back to 150. And we just kept doing that the whole way up. It's a beautiful thing. You just got to make sure that you don't get it wrong, because at 150 becomes 160, 170, and you're forced seller at the bottom. So you wait until after the turn and you just keep pressing. And that's what we did. So yeah, I don't know if I'm answering your question exactly, but basically since November of last year, October of last year, I've been running kind of at a 90 to 115. And I'm getting upside exposure because those out of the money call options, that right tail that I'm buying, and I'm buying in multiple products, not just oil. It's giving me huge upside exposure without a lot of balance sheet risk. And because it's mostly long dated paper, it's almost no delta to me either. So I don't worry about the pullback as much because I have a bigger view. And my structural view is Project Zimbabwe, and I've talked about this in many places, but I think they're going to just keep printing, and risk assets going to keep going up. But I think it's going to be very volatile, and I think there will be moments in time where risk assets drop 20 or 30%, and it spooks people, and they sell, and they probably sell to me, and we go back up again. And the trick is to run a portfolio that's maxed out long, but that gives you the flexibility to show up tomorrow and have your basket of names down 30% without giving you a margin call. And that's what I try to target, a portfolio that can do that. Where if JPOW comes out tomorrow and says we're doing an emergency 50, and we think inflation's 15. And we're literally 1,500 bips behind. We're going to take rates to 500 by Christmas. My whole book's going to get annihilated. But I'll live to fight another day, and I'll be able to leverage it, because eventually he's going to panic, and it's a political process. Now they want the price of broccoli to go down because they don't know if my mom's going to vote for them. In 3 months, when her IRA goes down, they're going to panic the other direction. So it's this kind of like sine curve on the way up, and you just want to basically be able to play the shakeouts without getting yourself shaken out, if that makes sense. And that's how I'm trying to conceptually build my book.
Yeah, and to wrap up the podcast, I wanted to ask you. It's sort of a really popular question. So what's it like moving to PR, Puerto Rico? What are your favorite parts and your least favorite parts about it? And what is it like from a financial standpoint as an investor? Because there's a lot of tax advantages that you get with moving to PR.
So I love Puerto Rico. I didn't really know what to expect when I first moved there. You never really know what to expect. I live in Rincon. It's beautiful. Really friendly people. Just a beautiful place. It's tropical paradise. I kind of like to like Puerto Rico quite a lot. Obviously, there's some tax advantages. It's what brought me down there originally, but it's my home now. I'm super happy to be there, and I recommend everyone comes takes a look. I think it's a great place to run a business, and especially a business that gets the tax advantages in terms of the community. Is a rapidly growing community of somewhat like-minded people that have also moved down there. I think it's great. It's obviously helping the Puerto Rican economy grow, which has been mired in recession for decades. I think it's a really great place to be, and I'm surprised more people haven't done it.
Yep. Awesome. With that, thank you so much for being on the podcast, Cathie. It was great having you. I think it was a fantastic interview. So thank you.
Hey, happy to come on anytime.